This is The Gist, the essential podcast for the discerning listener.
Welcome to The Gist. It is Sunday, August 23rd, 2026. I'm John.
And I'm Mary. We are your smart friends on the go, making sense of the day's news. Let's get right to it.
We start with the Gist view. Today, we are looking at a Swedish legal tech startup called Legora. They just hit a $5.55 billion valuation.
They did it by reaching $100 million in annual recurring revenue. That is predictable, subscription-based income. And they did it in just 18 months. The Financial Times notes that legal services are a $1 trillion global market.
Here is the catch. Legora did not build a massive, complex artificial intelligence system from scratch. They are what is called an artificial intelligence wrapper. They basically rent the brain of a foundation model, like Open Artificial Intelligence's GPT-4. Then they put a clean, industry-compliant interface around it.
So, who actually benefits here? Corporate law firms. Foundational artificial intelligence compute costs are dropping, but law firms are keeping their billing rates exactly the same. They use Legora's software to do the heavy lifting of junior associates. Then they pocket the massive difference as partner profit. It is a perfect arbitrage.
It really is. They are projecting $300 million in revenue this year, but their competitive moat is paper thin. Foundation models are advancing so fast, they will soon handle complex legal reasoning on their own. That threatens to wipe out wrapper startups entirely.
Right now, though, the real money in artificial intelligence isn't in building the smartest model. It is in regulatory capture. Legora solves a compliance headache for legacy firms, and everyone gets rich in the gap.
Speaking of artificial intelligence money, let's pivot to the global overview. Wall Street financiers are getting nervous. According to the Wall Street Journal, deep skepticism is brewing over artificial intelligence returns.
The backlash against artificial intelligence data centres is shifting. It used to be about local disputes over power grids and land. Now, the doubt is about capital viability. Investors are asking if these massive artificial intelligence systems will actually generate enough cash to justify the billions poured into them.
Over in the media world, a massive consolidation attempt just hit a brick wall. California and 11 other states sued in July to block an $81 billion merger. The players? Paramount and Warner Bros. Discovery.
This is a classic power struggle. The legacy studios are trying to bulk up. They want to unite their forces to fight off dominant big tech streaming platforms. Global distribution power is shifting, and the old guard is fighting for survival.
Meanwhile, French President Emmanuel Macron just hosted the Saudi Crown Prince, Mohammed bin Salman. They met at the Paris Esports World Cup of all places.
But they were not just talking about video games. Reuters reports they advanced new tech and health agreements. More importantly, they mapped out alternative energy transport routes. The goal is to bypass the Strait of Hormuz, a crucial but highly unstable shipping choke point.
And finally, in global news, the fast fashion giant Shein is hitting the brakes. They keep delaying their initial public offering, or IPO.
Growth is stalling. United States and European regulators are turning up the heat. They are targeting Shein's opaque supply chain. They are also cracking down on Shein's use of tariff-exempt shipping. That is the loophole Shein uses to dodge taxes and keep its clothing costs artificially low. The free ride might be ending.
Let's bring it closer to home with the European perspective. Let's look at the Stoxx Europe 600. That is a broad stock index tracking companies across 17 European countries.
According to UBS, companies in that index saw their average earnings per share jump 18% in the second quarter. That sounds fantastic.
It does, until you zoom out. There is a catastrophic $34 trillion valuation gap between Europe and the United States. Back in 2008, that gap was just $3 trillion.
So where is the money going? The Centre for Economic and Policy Research points out that Europe relies heavily on legacy sectors. We are talking banking and defence. Europe completely misses out on the scalable software platforms that drive massive, compounding growth.
It is entirely intentional. Europe prioritizes domestic financial stability. It enforces strict antitrust laws to protect consumers. The United States prioritizes building unassailable tech monopolies. Europe relies on traditional bank lending. The United States relies on massive venture capital.
And that is exactly why startups like Legora are aggressively expanding into the United States market. They cannot reach massive scale on home soil. Europe's reliance on bank debt forces its best innovators to cross the Atlantic just to find growth capital.
On the environmental front, emergency crews are currently maintaining flood barriers to contain the protracted High Fens wildfire. And that same defensive mindset is applying to city planning.
European urban planners are pursuing structural adaptations to extreme heat, but they are refusing to rely on mass, United States-style air conditioning. Instead, they are prioritising passive cooling alternatives. The goal is to protect local power grids from crashing and to stop cities from turning into giant heat islands.
Finally, some good news for the German economy. The IFO Institute is a Munich-based economic research group that tracks business sentiment. They report that their price expectation index dropped significantly. It fell to 21.6 points in July, down from 26.1 in June.
That means German corporations are pulling back on planned price hikes. Energy costs are stabilising, and there is hope for geopolitical de-escalation. It is a welcome breather for everyone's wallet.
Let's look at today's temperature. The underlying theme across the globe is a desperate scramble to secure bottlenecks. Law firms are capturing the gap between cheap artificial intelligence and expensive billing rates. Legacy media studios are trying to merge to survive big tech. European startups are fleeing a debt-heavy continent to find United States equity, while regulators globally crack down on supply chain loopholes. The resource flows are shifting rapidly, and the old moats are drying up.
If you enjoyed today's breakdown and want to stay ahead of the curve, you can get the gist delivered right to your inbox every single morning. It is totally free. Just tap the subscribe link in our show notes. Thanks for listening, and we will see you tomorrow.
The Gist, News Digest, and podcast are entirely written and produced by artificial intelligence. The Gist is out 3 times a day, every day, providing you with a liberal perspective on what to expect next. For more information and donations, visit thegist.online. Thank you for listening.